For hundreds of years, going all the way back to the first horse drawn carriages, people have paid some service to get them from one point to another. As horses gave way to cars, taxis became a dominant mode of transportation for many commuters. With the spread of mobile and the internet, transportation shifted from a service gatekept by a few connected business owners to a commodity good that allowed anyone with a car and a mobile app to service anyone else looking for transportation. The applications that connected these riders to drivers became what we know of today as the ride-hailing industry. Several ride-hailing companies have come onto the scene since the early 2010s, but the two services that have stuck around for the longest period of time are Uber and Lyft. This has also resulted in the two companies fiercely competing to get a greater share of a slower growing pie. In studying these two companies, we'll see how they operate and try to get some clues about why their stocks have been going in the opposite direction in recent times. The Uber versus Lyft story can teach us a lot about investing in duopolies, so join us as we look at how it's going in the ride-hailing wars. Let's get into it. Uber's history. Uber's roots go back to 2009 when the co-founder of StumbleUpon, Garrett Camp, came up with an idea to introduce a software app that would help people move within a city. Camp and his friends Oscar Salazar and Conrad Whelan built a prototype of the mobile app called UberCab. Travis Kalanick, another friend of Camp, became the company's advisor and later CEO. After a beta launch in May 2010, Uber services and mobile application became publicly available in San Francisco in 2011. Initially, the app permitted users to hail a luxury black vehicle, with pricing set at around 1.5 times that of taxi fare. In 2011, following complaints from San Francisco taxi operators, the company rebranded from UberCab to simply Uber. In April of 2012, Uber launched a service in Chicago through which users could request a regular taxi or an Uber driver using its mobile app. Uber launched UberX in July 2012, a more affordable option that permitted drivers to use non-luxury cars, although they needed to possess a California Public Utilities commercial license. In April 2013, Uber added regular drivers with personal vehicles to the UberX platform instead of only commercially licensed vehicles. That exploded the number of drivers within their pool, but those drivers were also required to have insurance, and Uber did a background check before registering them. This model was such a huge success that Uber had blitzed into 65 cities across the United States by the end of 2013. Uber kept on expanding its services in the following months and years at a pace of roughly one new city added on the platform every week. In 2014, the company introduced a transport service in San Francisco Bay Area and launched a food delivery service as well by the name of Uber Eats. In 2014, the company launched its service in China under the name Yubu, but faced stiff competition there. As a result, it sold its China operations to Didi in exchange for 18% of the Chinese company. Similarly, the company had merged its services with Yandex Taxi in Russia, Belarus, Armenia, Georgia, and Kazakhstan, and with Grab in Southeast Asia in 2018. The company's explosive revenue growth from 0 to 50 million in a 2-year span attracted some of the world's largest growth stage investors. Before its IPO, the company received venture funding from a cadre of global investors, including TPG Capital, Baidu, and Saudi Arabia's Public Investment Fund. These investments were truly massive, with TPG Capital investing $258 million in Uber in 2013, and later investors like Baidu and the Public Investment Fund coming in with a whopping $1.2 and $3.5 billion respectively. Uber used its cash pile to support global growth through acquisition by picking up Careem in 2019, another ride-hailing service for $3.1 billion. Uber is currently the world's top ride-hailing service with operations in 71 countries and over 10,000 cities. Now, let's talk about Lyft. Lyft's history. We can hardly say that Lyft was a fast follower to Uber, as the company launched in 2012, almost a full 3 years after Uber's successful launch. Lyft was founded by two computer programmers, Logan Green and John Zimmer, but it wasn't the first ride-hailing venture they initiated. 5 years before Lyft, the two programmers had launched a long-distance intercity carpooling company by the name of Zimride, which mainly focused on college students as its target demographic. In 2013, the original Zimride service was sold to Enterprise Holdings, the parent company of Enterprise Rent-A-Car. Lyft knew early on that it needed a way to differentiate itself in the ride-hailing market. What stuck was its quirky marketing and branding that included furry mustaches on vehicles. Early on, Lyft's brand identity centered on counterculture community that wanted to signal it was different from Uber. Drivers attached pink mustaches to the front of their cars, and riders were encouraged to do things like sit in the front seat and select music for the ride, all while casually chatting with and fist-bumping drivers. The pink mustaches were eventually changed by Lyft in 2015 when it introduced Glow Stash, a small glowing mustache meant to be put on a car's dashboard. By positioning itself as a fun alternative to Uber's polished brand image, Lyft endeared itself to a loyal customer base that wanted choice and liked nonconformity. Over time, the mustaches faded away, and Lyft began to slow down on bombastic branding, but it worked to establish a firm number 2 spot in the ride-hailing market. Some of Lyft's first global expansion saw its operations move into Canada, mainly in metropolitan areas around Ottawa, Hamilton, and Toronto in 2017. The company partnered with Allscripts the next year to help healthcare service providers book rides for patients who couldn't make it to the appointments on their own. After Cars, Lyft saw potential in bike renting and acquired Motivate, an operator of City Bike and Capital Bike Share, in 2018 with a plan to add 28,000 city bikes across various locations. In August 2020, Lyft collaborated with car rental company Sixt to offer users access to rental vehicles in return for a commission. The majority of rental cars are owned and managed by Sixt out of 85 locations it operates across the United States. After acquiring Motivate, Lyft announced in April 2022 that it had reached an agreement to acquire PBSC Urban Solutions, a Canadian bike share and equipment technology supplier. What's startling to many is that finally, in 2024, a full decade after its founding, Lyft announced that it achieved GAAP profitability for the first time in its history, thanks to its highest ever number of riders using the service and its sustained increase in its market share. Like Uber, Lyft saw big growth funding before going public. In 2015, Rakuten invested $530 million in the company. 5 years later, Lyft raised $600 million from Fidelity and Senator Investment Group. Massive amounts of capital for sure, but nowhere near the cash hoard amassed by Uber over the same period. Going public was the next major milestone for Uber and Lyft. So what was it like for them on their first day in the stock market, and how have they been doing since? Going public. Although Uber started 3 years before Lyft, both companies filed paperwork to become public on the same day, December 6, 2018. The race to IPO was kicked off by Lyft, which was first to file. Market analysts reported that Lyft's filing was a shrewd move at the time, as Lyft needed cash to continue to eat into Uber's market share while Uber's management was caught up dealing with a series of scandals. Scandals that market pundits believed would make it difficult for Uber to invite even more analyst scrutiny in their bid to go public. Both companies acknowledged the risk factor of competition in their S-1 filing. Uber said the company might have to further lower the prices it charged because of its competitors. And there was also a chance of competition developing successful commercial autonomous vehicles before Uber. As for Lyft, the company said it faced intense competition and could lose market share to its competitors. Starting with Lyft, the market saw them IPO with 32.5 million shares priced at $72 a share, which would make the company raise more than $2 billion on IPO day, the highest figure in the company's expected range. Unfortunately, the exuberance did not last. A week after going public, the company's shares were trading down at $57 a share. Then in 2020, 1 year after IPO, with the world locked down under a global pandemic, Lyft was trading as low as $26 a share. Now let's take a look at Uber's IPO listing. Uber's initial public offering was expected to be one of the largest IPOs of 2019. The company did make history, but in a slightly different way. Before the company went public, in May of 2019, some investors and experts predicted that Uber would reach as much as $100 billion in valuation following the IPO, but the company ended up far short of that figure and was able to raise just $8 billion. As for creating history, Uber initially offered its stocks at $45 a share. However, as soon as the market opened, the share price dropped 11%, which was the biggest first-day dollar loss in US IPO history. The shares slowly gained value and were back to $45 after a month, but the price went down again in the following months, and Uber's share was selling at $32 a share by May of 2020. Now it's time to talk about the valuation and revenue trajectory of both companies. Financials. Interestingly, despite being two of the most used ride-hailing services in the world, neither Uber nor Lyft had been profitable until 2019 when Uber finally achieved that all-important milestone. Although Lyft's profit margins had increased to nearly 40% when the company went public, it was still facing challenges covering overhead costs, including those associated with growing its market share in cities dominated by Uber. In 2018, although Lyft was able to make a net revenue of $2.157 billion, it still faced a loss of nearly $1 billion. This story hasn't changed much over the past few years. In 2023, Lyft made a revenue of $4.4 billion, which was 8% more compared to what the company made in the previous year. However, it recorded a net loss of $340 million. Although this figure is 5 times less than the net loss of $1.6 billion it recorded in 2022, the company's net income was still negative. As for Uber, in 2018 its net revenue totaled $11.27 billion. But just like Lyft, its net income was also in negative territory, with the company operating at a loss of $1.8 billion. Uber operated at a loss for 4 years until 2023, when it recorded its first net profit. Investors backing these companies have changed over the years, with earlier stage investors prizing growth, while later stage investors push management to prioritize profitability and market share. Given shifting investor sentiment, now let's take a look at these companies have responded. Growth and market share. When Lyft disclosed its market share statistics for the first time, it showed that the company held 35% of the ride-sharing market and dominated several other markets in the country. By 2019, Lyft was giving an average of 10 million rides per week to 23 million active riders. However, the number of users have slightly decreased since then, with the company providing 22 million active riders in 2023. Lyft may have captured market share from Uber due to a series of controversies leading up to Uber's IPO, but in subsequent years, Lyft's market share has fallen. In contrast, Uber market share has remained steady over the past few years. A survey conducted by Bloomberg in 2024 revealed that Uber's market share is approximately 76% of the ride-sharing market, far larger than Lyft's, sitting at around 20% market share. While Lyft's 10 million rides per week sounds impressive, that figure is dwarfed by the scale of Uber's operations, facilitating 2.6 billion trips in the first quarter of 2024 alone. One important factor in winning market share has been price sensitivity of riders. Cost matters, so let's dig into how much a trip with each of these services would normally cost you. Cost of services. Uber's pricing structure includes a base fare along with charges based on time and distance. The amount of fare being charged also depends on the type of vehicle and the city in which the service is offered. During peak demand hours, the pricing increases, which increases the fare. Every vehicle category has a minimum fare to ensure that drivers are compensated for their time when picking up passengers, even for short distances. In certain cities, Uber does not provide fare estimates in advance, but instead determines the total cost of completion of the ride. Among the available options, Uber SUV is the most expensive, while UberX offers affordable rates. According to a study by MSN, an Uber ride cost $30 in 2020, now costs $31.50. That's an average of a 5% increase in the average fare in 4 years. As for Lyft, there was a jump in prices when COVID-19 restrictions were eased out in 2021. Between January 2020 and July 2021, the average cost for ride-sharing services rose by 50%, reaching an all-time high. Like Uber, the fare of Lyft varies depending on location and the type of category of vehicle selected. For instance, according to Lyft, the fare in New York City is $1.82 per mile or 78 cents per minute for its standard Lyft service. Lyft fare includes a base rate price for each ride, along with additional calculations for the total distance covered and duration of the trip. If you book a ride in peak hours, and if the rider makes any changes to their trip during the ride, that also affects the total cost of the trip. Besides price, customers also take into account their experience with the service. And this is where it gets interesting, as both Lyft and Uber have had a fair share of controversies that they've been involved in. Controversies. Over the years, both Uber and Lyft have found themselves at the center of several scandals, including a disregard for local regulations and safety concerns. Uber has been repeatedly accused of starting its operations in new cities without any regard for local laws and regulations. Whenever it was criticized for disregarding regulations, Uber played the role of a small business victim and sought public support for its services. The reality was anything but. The company, backed by hundreds of millions in venture funding, had the cash to hire lobbyists and contribute to local political campaigns to change or dismiss any regulation that might become a hurdle to its operations or threaten its business model. In 2014, Uber told some of its drivers servicing California airport riders to ignore local laws and assure drivers that Uber would pay any fines levied against drivers for breaking local traffic and commercial safety laws. In 2019, California Assembly Bill 5 was passed. This bill addressed the employment status of persons hired as independent contractors. Following passage of the bill, Uber said that it would not abide by the law and then hired lobbyists to get the bill overturned through a vote. The company's response to challenging state and municipal laws has worked in the past 15 years, as Uber has never lost a lawsuit brought forward by any taxi operator. In 2023, both Uber and Lyft reached an agreement to pay New York drivers with a settlement of $328 million following an investigation by the state attorney general into wage theft. According to the complaint filed, the companies were taking different taxes and different fees from different drivers instead of the actual passengers conducting the rides. In the same year, Uber and Lyft drivers went on strike in both the US and the UK to protest wages and fees. They were also joined by DoorDash delivery drivers. However, the companies announced that the strikes didn't hurt driver availability or customer demand. There have been attempts by drivers of these ride-sharing companies at unionization as well. In 2023, Uber and Lyft drivers tried to unionize in a hope to have the ability to bargain over compensation, safety measures, and other benefits. However, their unionization efforts saw a setback when the UK's top court gave its ruling against the drivers of Deliveroo, who were also trying to unionize. The court said they didn't have a collective bargaining right. Even though these controversies, both Uber and Lyft have had the staying power to weather them. So between Uber and Lyft, who is winning at the moment, and what can we learn about investing in a duopoly? Who is winning? Despite coming into the market 3 years after Uber, Lyft has proved itself as a strong competitor to Uber. However, the company has failed to expand beyond the North American market compared to Uber, and it operates in dozens of countries and thousands of cities across the globe. Uber has expanded its terms of services that it offers. From food to package delivery, the company offers a more diverse set of services to its user base. Lyft has also launched similar services in recent times, but is really playing catch-up to its rival. Over the 2-year period of December 22nd to December 24th, Uber's stock price has grown 80%, while Lyft's has decreased 7%. These companies' trajectories are not on the same plane. And as of Q1 2025, investors are willing to pay to get into Uber compared to any competitor's stock. In this duopoly, Uber is enjoying a commanding share of a growing market and is considered an industry leader by many for 5 key reasons. 1. Revenue streams. Uber offers a wider range of services beyond ride sharing, including Uber Eats, Uber Freight, which give it more revenue streams than Lyft. 2. Global reach. Uber operates in 71 countries and over 10,000 cities compared to Lyft, which operates in the US and Canada only. This helps Uber avoid market concentration that could negatively impact them should local economic downturns happen. 3. Tech. Uber has invested heavily in technology, including self-driving cars, EVs, and software development, particularly pricing algorithms, which can make all the difference in retaining drivers on the platform. 4. Leverage. Compared to Lyft's market cap of $6.09 billion, Uber has a larger market capitalization of over $126 billion, which allows it to borrow and invest with more favorable terms to service its expansion, product development, and marketing needs. 5. Brand. Over the past decade, Uber has successfully established itself as a well-known and trusted brand across the globe, which is helping it attract more drivers and consumers that are willing to pay a premium for access to higher quality rides and drivers. Having said that, Lyft is by no means dead in the water. Lyft has turned the corner on profitability, and from the second place position can work towards improving at least 1 or 2 of the 5 key factors that we mentioned to make them more competitive with Uber. So what do you think? What would it take for Lyft to catch up? Out of the 2 companies, which would you invest in? Which have you invested in? And how's it going for you? Do let us know in the comment section below, and before you go, hit the like and subscribe buttons. See you on the next video.